Welcome to the trade. Before we get into the charts, let's take a look what traders are watching out there today. The US labour market remained mired in its low hiring, low firing doldrums through September, though the economy may be on a somewhat firmer trajectory than expected. That was according to Fed Chair Jerome Powell, noting policymakers will take a meeting-by-meeting approach to interest rate cuts. The IMF edged up its 2025 global growth forecast on Tuesday as tariff shocks and financial conditions have proven more benign than expected, but warned that a renewed US-China trade war could slow output significantly. And US President Donald Trump said that Washington was considering terminating some trade ties with China, including in relation to cooking oil. And US bankers predicted business would continue to boom as equity markets surged over the last quarter and the economy and consumer spending held up despite sweeping tariffs, but some warned asset prices may be unsustainably high. Let's now turn to the charts, and Nadine caught up with Violeta Todorova from Leverage Shares.
This is a very good point. Yes, I'm getting on the cautious side. You know, I've been quite bullish on the markets for the last 2 years. And after the early year sell-off, if we look at the chart on the S&P 500, we've seen an interrupted move since the April lows. And in particular, the RSI indicator was very firmly into the bullish market range, trading well below the support of 40%. However, Friday's sell-off is changing the picture. And if we see the bearish divergence that has formed over the past 3 months, and the penetration of the RSI indicator below the key support, this is where the caution comes. It is very similar to what we've seen before the market pulled back in January, February, earlier in the year, when we had a similar bearish divergence between the price and the RSI indicator. And I've put some arrows just to see the precise moment when we had a confirmation from the RSI that internal momentum conditions are deteriorating, which is signaling that the market rally is overextended and it's due for a correction. So we have the two warning signs on the chart. And let's not forget that the US government is in a shutdown, and official crucial data in regard to labor and CPI inflation is absent. So we are now entering earnings season. The bank season is kicking off today and tomorrow. So earnings will be the de facto calendar in the US. But given the strong runs from the April lows, I think that rally is priced for perfection. So if we see any signs of disappointment during this reporting season, that will be an excuse for investors to start taking profits off the table.
Really
Having said that, I am not very bearish on the market. I still believe we will see an extension of the rally. Yes, the market is expensive, but I don't have the definite signs of major market top. So what I'm looking at the moment is a mild pullback in the next couple of months. So we will be watching at support of 6,550. I believe that level of support is going to be broken eventually, which will trigger a pullback to around 6,350 points, where I believe deep buyers will emerge and potentially support the market. So for the moment, a lot of caution, taking some profits off the top, but not turning overly bearish. And I believe with few more interest rate cuts coming out of the US, 2026 can bring the S&P 500 to 1.61% Fibonacci extension, which crosses at around 6,950. So I still see a little bit of room on the upside over the medium term.
Okay, so really interesting. How does that translate, if at all, to the XJO? Or what are the technicals telling us for the ASX 200?
Yes, we are seeing very similar pattern on the XJO. However, I'm seeing a little bit more weakness in terms of price action over the past few months, while the relative strength index is showing that still there is no sign of deterioration in the internal momentum conditions. But again, here I drew a very large bearish divergence, which is forming on the chart. And clearly the rally from the April low, it's beginning to lose momentum, and we are currently trading in a range over the past 2 months. So investors should be keeping a very close eye on key support of 8,731, which in my view, it is going to be broken in the near term, which will confirm that a short-term top is in place, which could potentially trigger a decline to around 8,400 points. At least it could be a little bit deeper, where again, I think deep buyers will emerge and we will see the index rebounding in 2026. Looking at some Fibonacci extensions, I think the 1.61% Fibonacci gives us a price target of 9,400 points for 2026. So again, I'm cautious short term, but next year we are going to see extension of the cyclical bull trend.
Okay, so we've got some bulls in the house still. What did you make on the charts of that absolutely, never been seen before move in digital currencies? I guess relatively speaking, on Friday and through the weekend, Bitcoin held up well in comparison to some other digital assets, but I mean, it was quite a change for Bitcoin, wasn't it?
Yes, I do see a lot of correlation between Bitcoin and especially the Nasdaq, the technology sector. So whenever equity markets are rising, we see similar moves from Bitcoin. But that chart is actually my leading indicator, because I start to notice a weakening of the uptrend into Bitcoin a lot earlier. So this is, we can't put into the category of safe haven demand. I still see more correlation to equity markets than havens. So I noticed a very interesting pattern. That pattern doesn't form very often on the chart. And some technical analysts call it a megaphone pattern, but I call it the 5-point reversal, where we have higher highs and higher lows. When we have such a setup, this is indicative that there is a lot of uncertainty among market participants. And once we see such a formation, we associate this more often with market tops rather than market bottoms. So it looks like the near-term upside for Bitcoin, it looks like it is going to be limited. Again, we are seeing a very large bearish divergence forming, although the RSI indicator hasn't got into a bear market territory. So I think the price is going to continue to consolidate within the boundaries of that megaphone, but the volatility could potentially extend even further, which doesn't bode well for equity markets in the near term if we follow that correlation. So I believe we are going to see a little bit more weakness in the near term, potentially Bitcoin dropping to around $100,000, which I believe this is a level where Bitcoin is going to find support. And in the next 3 to 6 months, potentially we can see it rebounding to around 134,000, where I will start getting concerned and see some signs of a definite market top forming.
Yeah, right. Okay, so one to watch. What about gold? Still bullish?
Absolutely. I'm still very bullish on gold, and it is actually acting as a true safe haven. Gold and silver have been the standout performers in 2024 and 2025. And I believe that this outperformance is going to extend into 2026. However, in the short term, I'm beginning to see signs that We are due for a pullback. There is nothing obvious on the chart. There is no sign of immediate reversal. However, we are approaching some Fibonacci clusters, which are suggesting that potentially around $4,200 an ounce, we can see a little bit of resistance emerging. I'm not expecting a very strong pullback in gold. The maximum downside that I could potentially see, it's around 3,800, but it is quite unlikely for gold to retrace to that level. I believe in 2026, until the first half of the year, gold could easily trade to around $4,500 an ounce, and by the end of 2026, potentially to around $4,900. So the party is not over. The macro backdrop, the tailwinds are there. There is very strong central bank demand. And with all the geopolitical risks which are forcing investors to fly to safety, this appetite for gold is going to continue. However, if we look at gold miners, which I suggested last month that they're going to outperform the price of gold, if we see a pullback in equity markets, I believe gold miners will pull back with the general market, while gold could continue to outperform. And once we see the pullback into the stock market over, gold miners will gather momentum and will try to catch up speed with gold again.